All right, like we talked about at the beginning of the program, Mark Shone is going to join us. Mark, thanks for taking some time.
Yeah, absolutely. It's good to be here. How you doing, Scott?
Good. And Mark is one of our certified financial planners in
San Francisco Bay Area.
the Bay Area,
but a lot
some
of
in Sacramento,
But he
and,
said
and Nevada.
like most of your stuff, you said you do remotely now, correct?
I do. Yeah. Most of it is remote, but there's still some in-person things. But yeah, it's probably 90% remote.
Wow.
Well, it's interesting how I think the pandemic changed a lot of our behaviors, mine included.
Yes.
And there's you think about long-term clients that would come in periodically for whatever the reviews are, and then now it's like, I think I'm good. Why don't we just do this? I mean, if I can go to the dentist remotely, I'd certainly choose that rather than driving all the way across town to see my dentist. And that's the same thing. Number one. Number two, just with we've got experts, a variety of different expertise that are in different parts of the country, all over the place.
Yeah, and they drop into meetings all the time.
Yes, and so if maybe a client's in the office with an advisor and we have a big monitor behind, that person pops in, or it's all remote.
Yes,
and that's not sometimes.
Yeah, I mean, it's a better client experience. Think about it. They hop in their car, drive 30 minutes to come to see you, spend an hour there, drive it's a 2-hour event that can be handled efficiently in an hour.
Yeah. Well, not only that, if you want a portfolio specialist, they can pop in the meeting briefly, or an attorney, or a CPA, or insurance expert.
Anyway, Mark, you have a story for us. Is this correct?
Yeah, I have a story and just some tactics more around some things that you can do within when you get market volatility.
Okay, and before you tell this, I got to tell you that you were on the show a while ago and you talked about Silicon Valley Bank and how you had put these collar around executives so that they were protected from a downside. And
yeah.
I've thought about that about 3 or 4 times, and how hard it is for a client to do that with a stock that's doing so well, right?
And think of it like insurance. There's a cost. You pay a premium for those guarantees,
right? How hard it is for that particular client. But then after they live through it, and the person in the next office didn't do those techniques and changed their life irrevocably forever.
Yeah.
Right.
Yeah.
It's chilling.
Not only premiums. Yeah. Not only premiums, but sometimes it's actual tax that you have to pay. I mean, there are some pain points, and it's against a stock that you are generally pretty excited about, as
yes,
created your lifestyle, all the things. There's all kinds of emotions around it as well. So.
Yeah, and you only do it with stocks that are doing really well.
That's good.
That's one of the only ones that you have a concentrated position.
Have that problem,
right?
Yeah.
So anyway, I want to thank you for that last conversation, because I have thought about it. In fact, I thought about it this morning driving into the show. I have thought about it no less than 3 times about just how actually, like, at the end of it.
That's why it's important for people to step back and say, what are they really trying to accomplish in their life? And most people get to a point where they're more concerned about not going broke than they are about becoming wealthier. And we get confused because we get excited.
Well, you spend money, not returns, is something that I often say to clients, right? So if you're not worried about headed to the cocktail party and my portfolio did X and yours only did Y, you spend money. It's capital. It supports your lifestyle. So you just have to think about it a little in a more broad sense. And you have to have the passion to get your clients to do the right thing. I mean, if you didn't have conviction and they didn't have the courage, we're having extremely different, conversations today.
Yes.
Than we had. So, it's important stuff. So that helps to kind of live through some of those things.
I mean, it's interesting. Like we've had communications training with our advisors. I mean, like sometimes the best people with numbers are not always the ones that are also the most outgoing and connecting well with people, right? And so part of the interesting about this profession, it's the people that can can do both, that are both good with numbers and highly interactive with people. And to your point, Mark, it's you've got to have the conviction, and then you need to be powerful. You need to be skilled enough to help guide that client down the journey to where they end up with that conviction.
Yeah, and they're thankful for it. So your techniques today, you're going to share a couple with us.
I wanted to talk about just a client that I have that when we saw market correction, what kind of things do we do? And there's essentially three main things that can happen. One broad case thing. We talked a little bit about direct indexing. You've talked about it on the show here, and that's the ability to tax loss harvest. Even when markets are going up, you have the ability to do that. Well, that puts you in a position to do some things that are as simple as rebalancing a portfolio when markets start to get very volatile, and to rebalance a portfolio without causing any taxation. So the decisions that you make and the planning work that you do years in advance help you be more proactive in an environment like this. So the first thing is just allow to do rebalancing without taxation.
And that's
that was the biggest thing.
And Mark, that's just because you've got loss carry forward that you've actually just kept dry?
That's correct.
Right?
That's correct.
Or rebalance in retirement accounts.
Or rebalance in a retirement account. Yeah, correct.
And maybe trying to look at the overall portfolio, let's say you got half your assets in taxable, half in retirement accounts, you might actually end up tweaking it a bit where you do a further rebalance in the retirement account and a little in the taxables to avoid triggering a tax bill.
To get to the target state of the portfolio.
That's correct. That's correct. And I do have some clients that, we harvest these losses, and you can do this while the market is trending up. So most people think, thinking, wow, why are we creating a bunch of losses? It's something that you can do while the market is appreciating.
Well, you're doing it because you're smart.
Yeah, it's helpful. And then they're like, should we use some of those losses? I've always getting asked, should we use some of these losses this year? I said, we're going to utilize the losses when there's a purpose. And that purpose is going to be to rebalance, to take cash out to do something. So you just want to be thoughtful about that.
And there's no time limit. We can carry forward realized losses indefinitely. Except to our grade.
You can't. But you don't really need them to your grave because they step up in basis.
Whatever.
That's correct. Yeah. Well, you also don't want to carry losses into your grave as well, because you get a step down in basis. So yeah. That's right.
That's just so bad.
That was really bad.
That was bad.
Nice try.
But the other thing that you could do is in these environments is sometimes it's a good time that if you have things that have held up pretty well in this environment, you'll do charitable giving with appreciated stock. So those are some of the things, either to reduce and get your portfolio back in balance. So growth stocks have done really well over a really, really long period of time. If we're going to be doing charitable things, instead of selling to rebalance, we'll use charitable giving to gift away those highly appreciated positions.
Did it last week. After the conversation, the exact conversation was, now is a good time to do this. And by the way, not only are you doing it because, we're going to do a lump sum, that rather than every year, let's do it every 3 or 4 years so that we actually get as much benefit out of it as possible. And the other is just for the record keeping, bookkeeping, the ease of actually gifting to charities, a donor advised
fund
makes it so easy.
Yeah.
Well, Mark, as always, appreciate you taking some time to be with us. Mark Shone, a CFP extraordinaire.
And Mark, how's the band going?
Is going well. We played after the last time I was on with you.
Yes.
All was well. Our hits on YouTube went way up. I will tell you that.
Don't get too famous out there. You're going to end up quitting Allworth.
Wait, stop.
Rock star.
Stop.
At sick. How old are you? 59?
59, yeah.
Mark,
59-year-old rock star.
Stop for a minute.
There's a real big heavy demand for 59-year-old drummers.
When you said the hits on YouTube went way up, like They doubled, so now you got 10?
Oh, no, 17.
That's funny. That's funny.
Thanks, Mark. Appreciate it.